nice to meet everybody today. My name is Jennifer Daniel. I work with the assessments team and lead our assessments team, which is part of the Consero sales cycle. I've spent about 6 years with Consero to date. I've spent some time on both sides of the house working with our implementation team. So that really means driving the change management of implementing systems and processes and bringing on people. And then I've spent 2 years working on the assessment side, which has given me the opportunity to talk to hundreds of customers about what they're looking for to optimize their systems and their processes and what it looks like and the pains that they're trying to solve as they go through and approach mergers and acquisition. Long-term, have a background in finance and accounting, and really excited to share some thought leadership with everyone today.
And hi, everyone. Chris Vignon, Managing Director of Source Advisors. I'm proud to say lifelong state and local tax expert. Work with hundreds of companies from small startups to Fortune 500 companies on complex state and local tax issues, including sales, income, property, and many other areas. Excited about today's M&A discussion. It's a hot topic with some of the changes over the last couple of years around sales tax. M&A due diligence is important. We do probably 7 to 15, depending on the year, buy side, sell side transactions a year. So we're very active and glad to share our thoughts and ideas and content with you today. With that, Jen.
Yeah, great. And so, well, actually, Chris, I'll let you hit this and I'll hit the next one.
Okay, great. So this is our agenda for today. Jen's going to share a little bit on the due diligence side, mainly on the accounting side, to talk about things to think about. I'm going to then dive in. A lot of this is going to be about taxes today on the state and local side. We're going to give you a quick 101 on stock versus asset sales regarding state and local taxes, talk a little bit about escrow, and then go into the different areas that we see are very common when it comes to the due diligence process that's brought up, obviously, by the buyer after that due diligence process. So there we go, Jen.
All right. And so really what we wanted to start today is the benefits of getting due diligence ready and making sure you're prepared for that. And the lens of the call today, one thing that we really wanted to walk through is how do we share some thought leadership with clients and customers and people that know that they're going to be facing due diligence based on what we see. And so really what we look at is, hey, you're looking for investment. You might be founder based, you might be a startup and high growth, and you're looking for that next step. And ultimately, when you're going to have investment, everyone wants to maximize their value. And part of that is being due diligent ready. What we're seeing in today's market as we talk with customers is as investment, it's taking more time. They're digging so much deeper. And so being prepared for that investment and how to be more prepared is something that we wanted to share today. Some of the benefits of being prepared instead of just kind of waiting till it comes and going through that due diligence cycle is that you're going to have an increased valuation. And so the main point of talking with Chris is, hey, if you're sales tax ready, this is actually going to increase the valuation of your company, given what can be found if you're not ready for that. There's obviously a lot of other benefits. You can lower your audit fees, the work on your employees. It's really hard to provide deliverables that you're not ready for because your systems, your processes, your things aren't in place that you're prepared. And it's going to help you move faster. I think one of the common words that we hear is time kills deals. And if you're not ready because you don't have things in place, guess what's going to happen? They're going to go deeper in your review and they're going to want to analyze more of the problems that they might find because they found one thing missing. And so our goal is to help give you the tools on the sales and tax space to help you facilitate that process. On the next slide for me, Chris, please. So one thing that we wanted to share that's a little bit more high level, in talking through our customer base, we kind of have 4 findings that are general that we see for companies that are just gone through a due diligence process. And one of the top things that we see is revenue recognition is not GAAP or 606 compliant. That's a pretty common theme. We're not really going to touch on that much today. But the second one is sales tax is not properly collected, committed, or not done at all. And what we end up seeing is you're going to have a quality of earnings, and it's very clearly stated in the quality of earnings where you're not collecting sales tax, the liability associated with that, and the impact to the valuation or the investment is that has to be shared dependent on what type of investment it is. The other thing that we see is you don't have appropriate systems in place. A lot of people leverage QuickBooks, and one of the first things that's going to happen when you go through due diligence is, hey, you're going to need to put in systems that can scale with the company. And part of that is to better accommodate for things like sales tax. So you have the mechanisms in place to be able to make sure you're prepared. The last thing that we also see commonly is your F&A team structure is inadequate. And so what that ends up meaning is, hey, you have no segregation of duties, you have no internal controls, or it might just be skill set. Hey, you've got a team that doesn't even understand when you need to bring in the sales tax or how you want to address revenue recognition. So this is just kind of general what we see. And when we say due diligence ready, what we've seen in the space of how you could be more prepared if you can address these four key areas. And this next piece is really just looking at kind of some stories. We've got two examples here. The first one's going to be with TA Associates, which is a PE partner, and it's talking through their experience of when Consero was owning the accounting function. You know, part of what Consero brings to the table is that you're always going to be due diligence or audit ready. We're going to have systems and processes in place and make sure you have things like compliance addressed. And that experience for them created a seamless sales cycle. You know, they were able to maximize the value of the company, and that's always everyone's goal. You know, one of the things that we hear talking to PE partners is, hey, you know, in today's market, we're looking for anything that they don't have right, and that's going to allow us to save on the investment and decrease the value that we offer. And so knowing that's the space and knowing how it's harder to get investments, really taking it serious to be like, hey, I don't really want to defer readiness. I want to be proactive and address it so that when PE comes in and they do that process, that you're prepared for success. The other example we have here is from a former CFO, Steve Isom, and just walking through how easy a transaction is once you have these things in place. So really trying to be representative of what it's like from a PE firm versus an individual CFO or controller, that once you become ready, you actually focus on the transaction. There's a lot that goes on. It can consume your entire organization when you're going through due diligence. And if you're having to worry about, hey, I don't have something in place, how do we come back to the table and present this fairly, is really our goal. So Consero can help support that in a lot of ways. One area we don't support is specifically sales tax compliance. And that's where we have partners with source advisors that they can come in. And as soon as you start working with Consero, if we see that gap, we actually do an introduction with Chris and his team to make sure you're set up for success as part of our support. So I'm going to hand it to you, Chris, to walk through this in more detail.
Great. Well, everyone, there's lots of content here. We're going to hand out the presentation as well. I'm going to go through this pretty swiftly. If you have any questions at the end, we can hang out a few minutes. If not, email them to me. But let's talk about state and local taxes. So whenever you're talking about due diligence and state and local taxes, the first question is, okay, stock or asset deal. So for those of you that don't know the difference and how it impacts state and local taxes, let me just give you a high level. So obviously an asset deal is where the buyer is coming in and buying the assets of the company. They may buy some selective liabilities, but they're not acquiring the stock and not acquiring the entire company. Stock sale is exactly as it says. It could be a merger, it could be an acquisition, it could be a partial cash, partial stock deal, but that's when they're effectively acquiring the entire company through acquisition of the stock. There are significant state and local implications between stock and asset sales. Under a stock sale, the buyer accepts full successor liability for all taxes. Okay, so when you do stock deals, obviously the due diligence level is higher. They dig in some more. Income tax, not always important, more important on a stock deal. Okay, and sales tax is always important, as we'll talk about this in a minute. But generally, the level of due diligence on a stock deal is going to be higher than an asset deal because the company is going to be taking over, the buyer will be taking over all liabilities on the balance sheet, as well as all sales tax liabilities, known or unknown. Under an asset deal, the buyer only acquires the assets of the company and generally does not acquire any liabilities. It is possible to acquire select liabilities, but in most cases, it's really minimized. Most states require a bulk sale notification when the sale of 51% or more of the company is acquired, 51% more of the assets is acquired. This may be required by the buyer or the seller. So when you do an asset deal, the states know that the buyers may not be on the hook, so they require this sale notification. And what has to happen is this is a form that's sent into the state and say, hey, we're about to sell the majority of our assets of our company. Please provide us with basically a tax clearance certificate in some form. Each state calls it a little bit different. This is an opportunity for the state to say, hey, buyer, just so you know, the seller owes us money on sales tax, owes us money on income tax. Most states only require the bulk sale notification for trustee taxes liabilities, such as sales or payroll taxes. A few states, as we're going to look on, do require it for income tax. Okay, so bulk sale notification is going to happen as part of an asset sale and is going to require the seller to basically open up the kimono, right? And they're going to, the buyer's going to know everything that's going on. As part of this, you basically validate that you've paid all your taxes, everything that you know, and that you've paid those, and the state will come back and let the buyer know, hey, here are the liabilities that we think outstanding. It'll also allow the state to identify anything that they may not have identified in the past. Like I mentioned, some states like PA and Illinois also require a bulk sale notification for income taxes. Like I said, also the seller generally agrees to pay any known back taxes if there are. And if the bulk sale notification is not filed timely, the buyer will have successor liability for all applicable taxes. So when you're going through due diligence, this is going to definitely be, and you have an asset deal, there's going to be a specific part where you and the seller, you and the buyer are going to talk together, get the bulk sale notification filed with the state. The buyer is going to want to make sure there are not any known liabilities that are hanging out there. Now, there's some confusion many times in the language. A bulk sale exemption is different from a bulk sale notification. A bulk sale exemption is an exemption that most states have, okay, where when you transfer the assets only, there is no sales tax in the transfer of those assets. 3 states, larger states, New York, Maryland, Washington, are 3 states that do not have a sales tax on the asset transfer. So one of the downsides of doing an asset deal on the tax side versus a stock deal is that on an asset deal, if any assets are in any of these 3 states, you may have to pay sales tax. If it's an asset that could be resold, like inventory, you don't. But for any type of computers, buildings, any type of tangible property in certain states, as part of a bulk sale exemption, you may have to pay sales tax, unless I mentioned those 3 states here. As part of the process, the seller may be required to issue a resale certificate if it's for an item such as inventory. All right, so that's our high-level 101 on stock versus asset deals. Let's talk about, before we dive into the meat, let's talk about how do buyers manage identified risk through an escrow account? First of all, most buyers have a specialized team that comes in. It will usually be some of the same team members that are part of the financial due diligence team doing your state and local tax due diligence. They'll also likely be part of the same team that's doing your federal tax due diligence. Okay, so that team brings in their team of SALT experts. They rip through your financial statements and they come up with these potential liabilities. Well, number one, the buyer will usually escrow accounts to reduce risk related to any state and local tax issue. So if you're sitting here now as a potential seller, just so you know, all of these items will be escrowed that we talk about today. But sellers should also be prepared to respond to the buyer's concerns and act immediately to reduce the value of an escrow account. That's why we're here today. If you're thinking about selling and in the process of selling, realize that what the buyer comes to you with is really negotiable. Also, the buyers will also layer in penalties and interest onto the tax liability estimate. So these escrow estimates can be really high. Buyers like to negotiate long periods of time as well to maintain escrow for tax accounts. Sometimes tax issues take years to resolve. And when you're negotiating with the buyer, there's some ability to negotiate the time period where the escrow or the milestones will be cleared, as well as the dollar amount. Listen, at the end of the day, the buyer is going to do his best to identify potential liabilities to knock down the price. These are all negotiable. But the best way to successfully negotiate these is to be prepared. Bring the items up that you know about, or at least be prepared to talk about those and say, hey, we know about it. We're ready to talk about it. Here's why we don't think the liability is as much as you think. We have seen deals almost crushed because of sales tax liabilities over the last 5 years. Companies that have not complied and not collected sales tax. So this is why we're teaching you these items today, so you can be prepared to negotiate when that time comes. Okay, Number one issue right now, state and local due diligence. Don't forget, this is not federal tax, state and local tax, but on the state and local side is sales and use tax. So a little primer on something called the Wayfair rule. For over 50 years, the states respected this case, National Bella Hess Supreme Court ruling. The Commerce Clause basically prohibited for 50 years a state from imposing the duty of a use tax collection or sales tax upon a seller whose only connection with customers in the state is common carrier or by mail. So basically, the rule was physical nexus was the law of the land for sales tax collection determination. The e-commerce boom of the last 20 years forced the state's hands to challenge this longstanding position. And on June 21st, 2018, in a 5-4 decision, the Supreme Court ruled in favor of South Dakota. Basically, Wayfair is the company that we all know. It was South Dakota v. Wayfair. And Wayfair lost and had to agree to collect sales tax going forward in the state of South Dakota. And then the wheels fell apart, or, all the other states obviously jumped onto it. According to the court's decision, the South Dakota law did not place an unreasonable burden on the retailers. And after 50 years, we went to an economic nexus standard as well as physical nexus. By the way, physical nexus is still in play, right? That's never changed. It's really economic nexus that's catching sellers by surprise that they haven't caught on to the last 5 years. Good news, bad news. The court applied a small business exemption that most of the states have honored and respected. They all have $100,000 in sales or 200 transactions. That's changed over the years. Also, the definition of what the threshold amount is changed, whether it's gross, exempt, wholesale. Several states immediately implemented economic nexus standards in 2018, and by the end of 2019, most states had a single rule in place for sales tax. All right, so we have this new rule in place. You may or may not be aware of it. What are the risks? So here's what we're seeing. First of all, complete non-compliance. One of the things we hear is, well, I knew about Wayfair, but I was an online e-learning company, and I just assumed that all our classes were exempt. Well, in-person classes are exempt. Most states exempt live online e-learning classes, but most states tax pre-recorded video. Okay, so sales tax is very complicated. State and local tax is very complicated. Don't make assumptions without talking to an expert, especially before a potential sale of the business. The other thing we see, companies not registered in the proper states due to sales or physical nexus issues. So a company may be qualified, may be registered in certain states, but they haven't updated their nexus map in years. They haven't updated their technology and coding in years. And there's a lot of areas where they're non-compliant. Tax mapping, as I just mentioned, is another issue where we see get hit on due diligence. Companies will come in and see, we had one company recently reviewed a software company owned by a PE firm. We realized that about 72 of their codes were never mapped. They implemented technology years ago. We did an update on the tax mapping, and 72 codes weren't charging sales tax in states where they should be. Tax technology settings are incorrect. There's issues with states like Illinois and Colorado. You may say, hey, Chris, I implemented Avalara 3 years ago. I'm all good. You may not be good. Your tax mapping may be wrong. Your setting for Illinois and Colorado may be wrong if you haven't looked at that. There were changes in the last 3 years in those states where if you implemented an Avalara 3 years ago and haven't looked at the settings since then, you may be incorrectly over or under collecting sales tax in states like Illinois and Colorado. Wholesale manufacturers, distributors lack certificate documents. We see this all the time. Hey, Chris, I'm a wholesaler, I'm a reseller. I don't need to collect sales tax. Okay, that's fine. But did you realize for any state where you had nexus, where you had more than $100,000 in sales, you need to maintain all the certificates. If you are the buyer, if I'm representing the buyer and we're coming in and you don't have certificates, we are going to require you to go back to every single customer in every state where you have nexus and get the certificate, me sitting on the other side of the table. So if you're a wholesaler and have never thought about sales tax because you never had to collect it, you need to start working on the certificates, gathering that information, and have it available. In each of these circumstances, there is likely a large historical liability. Okay, sales and payroll taxes are what they call trustee taxes, and the business is collecting the tax on behalf of the state. Thus, the corporate or LLC veil does not protect the seller or the future buyer. Okay, this is different than income taxes. This is different than property taxes, where you have the corporate veil. You don't have to worry about personal liability. There is personal liability for the former owners and the future owners. When I mean personal, individuals that own the company, in some cases, individuals that simply work on the returns. All right, so you're sitting here getting nervous, Chris. Oh my goodness, I didn't realize I was supposed to collect sales tax, or maybe I'm doing it wrong. There's a way to mitigate that risk before the sale, before the negotiations, or even during negotiations with a buyer on the other side. Okay, first thing we want to do is, prior to a sale, perform an economic nexus study and do a full liability calculation. Doesn't take a lot of work. It's a few $1,000s, a few hours, and in a couple of weeks, you'll know exactly what your exposure is. States have applied different rules regarding how thresholds apply. So if you haven't done a study in a few years, update a study. If a liability exists, work with a consulting firm that can help you with liability mitigation. What people don't understand is that even though you have a historical liability, there are different ways that you actually may not have to pay that back. Once the liability is accurate and you've gone through those ways, I'll share one with you now. So if you've never collected sales tax, but you sell to big companies have a process to self-assess sales tax when the client doesn't charge it for them. So one of the things we do with companies that sell with big businesses that haven't collected sales tax is we'll call their clients and say, hey, listen, we're cleaning up our books. We're getting compliant with sales tax. Did you self-accrue or self-remit sales tax, or have you been audited for sales tax? So lots of little ideas we do to help you mitigate that liability. Once you lower the liability, we then talk about a fact, does a VDA make sense? A VDA is where we go to the state and voluntarily give them money. In exchange, the state reduces the look-back period to 3 years, eliminates penalties. Sometimes we can get an interest deduction. If you're a wholesaler, we talked about this before, okay? The same applies, but you'll need to collect exemption certificates from the states that you're required to collect sales tax from. And hey, if you're a wholesaler, a retail, manufacturer, and you go back to your companies and they don't want to give you a certificate, you should start charging sales tax. There's generally a reason they don't want to give you a certificate, and you should start charging sales tax going forward. So, hopefully we've made you a little bit nervous, but also given you a little bit of a path forward to hopefully mitigate that liability. Like I said, if you're in the process of due diligence, you're presented with a large sales tax liability, hire someone on your team to review it. Like we keep saying, the buyer will be very conservative, okay, and probably not consider any liability mitigation strategies. Although the buyer will be highly concerned with any historical sales tax liability, many items will be negotiable. All right, so we wanted to give them a little extra time to sales tax because it is complicated. I want to just highly talk about the also other areas that we see: state income, gross receipts, franchise taxes. There's a bunch of points on here. You can spend your time looking at them after the presentation. But just so you know, outside of sales tax, there are things like the Ohio CAT tax, Texas franchise tax, California franchise tax. These are taxes that are not protected by what's called PL 86-272. And if you haven't been collecting those taxes and you have economic nexus, you may have a liability there. In general, for companies that sell tangible personal property on the income tax side, you're protected by a federal rule called PL 86-272, where many states aren't allowed to collect net income tax from companies that are selling and don't have physical presence within that state. One of the other things we want to talk about is small business owners are notorious for electing not to file income tax returns in many states. We see a CPA say, okay, provide, small business, we have to file in 10 states. And by the time it's all done, they've convinced the CPA to only file in 2 or 3 states. Finally, on the income tax side, how services are sourced to each state also varies and can also be challenging. You may have a company coming in and doing due diligence and you filed in all the states, but you incorrectly sourced your receipts or your services to different states. So again, not the top issue, but always an issue: state income tax, gross receipts, and franchise taxes, and just be aware about that. Here are some of the risks. The buyer isn't reported income to certain states, and the statute of limitations is open forever. So, for the buyer, if they come in on a stock deal and they realize you haven't filed returns, If generally you get a state credit when you file a return in one state, you get a state credit in your home state. If it's been years, you may not get that credit. So that may be something that may come out of your pocket. The buyer incorrectly applied sourcing rules. We talked about that. Bulk sale notification is not required in most states for income tax. So the risk is low that the buyer will want to escrow, but stock deals are going to be more concerning. And on stock deals, the buyer is going to review this a little closer. And again, if the buyer is suggesting a large escrow account for past due income taxes, the seller should consider working with a third party, see if they can mitigate that. All right, we've got a few minutes left. Just going to mention a few other things. Again, please follow up with questions, emails, unclaimed or abandoned property. These are items such as uncashed checks, uncashed vendor payments, sometimes unreceived insurance proceeds, also gift cards. These are items that sit on your balance sheet and sometimes they never get redeemed. So the check doesn't get cashed by your vendor. For some reason, we don't really have payroll checks, but if you still have payroll checks, your employee doesn't cash a final payroll check. These are items that you are actually supposed to give back to the government. The biggest these days that we deal with is gift card programs. When companies have gift card programs and all of a sudden they have expired gift cards and they bring it into income, depending on how the program is written, that money is actually supposed to go back to the state. So 5 years ago, we saw a lot more on unclaimed property, abandoned property on due diligence. Today, we still see a little bit. It's really around areas of companies when they have large gift card programs. But I just want to mention that just in case you are surprised with that. Miscellaneous local taxes, we see this sometimes. City of Philadelphia Brit tax, LA business city tax, thousands of local business license taxes. So if you have a business that has lots of physical locations, these taxes are generally based on physical location. So depending on the sophistication of the buyer, they may or not pick this up. But if you're a seller that has lots of physical locations, go back and see, are we filing our business license taxes? Is there a city business tax that we haven't been paying? And at least be aware of those taxes and maybe start being compliant going forward. Property taxes. The good news is that localities generally don't come back for old taxes. Property taxes are tied to local budgets, and once those budgets are done and passed, states generally move forward. But a buyer still may be concerned if they come in and see that you've never filed property taxes in a state that has a large property tax bill. This could be a quality of earnings adjustment, right? You may have never paid property taxes in a state you didn't realize you're supposed to pay, and this could be real or personal. Generally, personal property taxes are missed. For the most part, companies are aware of the real. The bill is sent out by the locality. But for personal property taxes, those have to be filed by the business and then paid later on. So again, not a big point, but something to think about. If you have estates that have a personal property tax and you have taxes that you haven't paid, this generally may not be an escrow issue, but it could be a quality of earnings issue because now the buyer will have this expense going forward. Finally, payroll taxes. Most buyers will perform due diligence on payroll taxes to ensure compliance. Generally, this will be both a federal and state issue. The number one thing that the buyers are looking for on payroll is if you're properly treating your employees as employees versus contractors. They're going to focus on individual contractors to see if they're really employees that you're just classifying as contractors. Although payroll tax is mainly a federal issue, there's also a state component to it. Sometimes we also see unemployment insurance and workman's comp policies that are reviewed. We do occasionally run into companies that run their own payroll. They remit withholding tax, but don't realize that certain states have their own workman's comp program or may miss or have outstanding unemployment liability issues.